What is up, guys and girls, and welcome to DecDoesInvesting, the wealth, investing and finance channel. Before we start, I'd like to ask you to hit the subscribe button to join me on my journey, and also hit the like button to help me out with the YouTube algorithm. In today's video, I have a stock from the UK that could potentially be undervalued from my analysis and could see potential growth in the future. In this video, I will give you some background information on the company in question, then look at the fundamentals and some analysis as to why I feel like this company is undervalued. However, I would like to point out this video is just for entertainment purposes and should not be taken as financial advice. As always, do your own research before purchasing any stock, as your capital will be at risk. So the stock I'm going to cover in this video is SDL, which conveniently also has the ticker symbol SDL and is traded on the London Stock Exchange. SDL was founded back in 1992 and currently has a market capital of £455.5 million and are from the application software industry. So who are SDL and what do they do? Well, taken from their website, SDL PLC provides innovative, industry-leading language solutions across the entire translation supply chain, including freelance translators, service provider solutions, language service providers, corporate language departments, and academic institutions. Since SDL's establishment in 1992, it continues to develop the largest portfolio of language technology solutions with over 250,000 product licenses, hundreds of server installations, and billions of translated words through its innovative machine translating engine. SDL is dedicated to supporting and developing translation software and services, such as the industry-renowned SDL Trados Studio for our customers and partners. If we take a look at the one-year chart of SDL, we can see that it was on a bit of a run-up before the market saw a crash and was at its 52-week high of £6.36. It has since recovered from its lows and at the time of making this video is now trading at £5 per share, which still gives it a discount of around 22% from its 52-week highs. Taking a look at shareholder returns now, we can see that over a 5-year period, SDL has returned 24.2%, which slightly lags its industry average of 27.3% over the same period. However, did outperform the market, which saw a return of 15.8%. Simply Wall Street and its analysts currently undervalue SDL by 14.7%, in which they give it a fair value of £5.86, which is calculated on the cash flows the company is expected to generate in the future. Looking at its value, and more specifically its PE ratio in a little more detail now, we can see that SDL is currently trading at a PE ratio of 23.2, which is lower than its industry average of 33.1, which means SDL is of good value in comparison to its industry. However, its PE ratio is higher than the market, which has a PE ratio of 15, and therefore does make it overvalued in comparison. If we now look at SDL's forecasted annual earnings growth, it is expected to grow 20.9%, which is greater than its industry average of 17.6%. However, falls behind the market, which is expected to grow 21.7%. Looking at SDL's forecasted annual revenue growth, it is only expected to grow 2.4%, which both lags its industry average and also the market, which are expected to grow 5.3% and 3.4% respectively. Moving on to the past earnings growth analysis now, we can see that SDL over the last 5 years have grown their earnings by 35.7%, which is almost double that of its industry average, which saw growth of 18.6%, and also beats the market, which saw a growth of 13.2%. This is also reflected in the last 1 year period, in which SDL grew their earnings by 32.4%, which massively outperformed the industry average of 12.8%, and also dwarfed the market, which saw 1.7%. Looking at SDL's earnings and revenue on a graph form, it gives us a better representation of the numbers, and we can see that revenue is really rapidly growing and profits are up from last year as well. Moving on to the financial position of SDL now, we can see that it boasts a very strong financial position in which its short-term liabilities of 107.1 million and long-term liabilities of 43.7 million are covered by its short-term assets, which is great, which gives both current and future shareholders peace of mind. Looking at the financial health of SDL now in a little bit more depth, starting by analysing its debt, in which SDL is actually debt-free, which means its operating cash flow can be spent elsewhere in the business to either help grow the company or keep cash in reserves for a rainy day. Finally, touching on to the equity of SDL, we can see that as of the 31st of December 2019, it had equity of £252.5 million. Finally, wrapping up SDL, it currently has suspended its dividend, which can be said for many companies right now. However, analysing the past history of these dividend payments, we can see that its previous dividend was 7 pence per share, which gave it a yield of around 1.3%, which is a little bit on the low side. If we analyse the growth and stability of this past dividend, we can see that it has cut its dividend before. However, before its most recent cut, it had been on the rise and growing year on year. I would like to add that I don't see this company being a dividend growth play, and in my personal opinion, one that should be purchased more for capital appreciation, as the dividend is neither high nor is it reliable. So that wraps up my analysis on SDL. Please let me know your thoughts and opinions down below. So if you've liked the video, please drop it a like, subscribe if you want to see more content like this, And if you've missed any previous updates, there'll be a link to the playlist in the description down below, along with some more videos that may be of interest. And until next time, peace.